Market Shots are short video segments designed to help you develop a trading strategy that you can stick with. Here to help you is the Chief Market Strategist for the Market Guys, A.J. Monty.
Hello and welcome to our next session, which is Dojis and spinning tops. Now this more or less feeds off of the last presentation that I did on hammer patterns, because the doji and the spinning tops are very similar, with one difference is that the doji, as I'll describe to you here, looks more like a cross and not like a mallet or a hammer as the Japanese rice traders described it as. Here I'll show you the difference just as a quick review. This would be a hammer pattern. Again, the definition of a hammer pattern is a small green candle with a long shadow that's 2 to 3 times larger than the body itself, and the hammer pattern is usually found at the bottom of a downward leg. A doji, on the other hand, looks like a very small body candle, but you'll notice here, this would be considered a doji, the opening and the closing price are almost the same, and you'll see that there are shadows above and below that horizontal hash mark. You'll see that dojis generally form at pivot points. Now they're not as reliable as a hammer pattern or a hanging man. However, they are most often found at pivot points. You see here the stock had gone up. This is OIH. I've just taken out the price and the timeline for you so we can focus more on the price action. This is an upward leg. You see the doji, pivot point, came back down, hammer pattern, pivoted back up, and then you can see that right here again we have a doji pattern. Right here again we have a doji pattern at a pivot point, 2 dojis actually within roughly 2 days from the actual high, and then you have another doji pattern that's roughly 2 days from the low. So you can see that again that 80-20 rule will often work for the dojis as well as the hammer patterns. Spinning top, let me tell you how to trade these. It's great to identify them, but again, it's always better to be able to learn how to trade from them. Here's how you trade the doji, then we'll move into the spinning top. If you see a stock that's going up and you have a long position, and then all of a sudden, bing, the alarm goes off, you see a doji pattern, the correct thing to do, if the doji pattern is shown at the top of an upward leg, is to at least sell half of your position. You sell half the position, and then you place a stop at the bottom of the low for that doji for the rest of your position. So in this case, the very next day you would have been stopped out of half of your position. Okay, if you see a doji at the bottom of a downward leg, you might be short. A short position is when you're making money on the way down. You borrowed stock, borrowed from your broker, of course. You buy the stock back lower. You buy half the position back on a doji at the bottom of a downward leg, and then you put your stop above, your buy stop now, above the high of that particular doji, whereas here you would have been stopped out. Again, if you're short, you're going to be covering your shorts. But what if you're not short and you're looking for a long position? Well, here's how I would trade this. A little bit different than the hammer pattern. When you see a downward pattern, I would only buy half the position in. So I'm scaling in at this point. I'm not cost averaging down. I'm only buying half. I buy half the position, and then I put a stop right below. Now this you might have gotten stopped right here, but what I'm talking about with the doji, you want to give yourself a little bit of a cushion. You're not going to have it pennies below the low. You might have it somewhere down here or down here. This is where you take some of that artistic license and you use it. If you're only buying half the position and you get stopped out the next day, no damage done. But here's what you do with the rest of the money. You take half, you buy half on the doji, put a stop below it. On the next day, if you see a green candle, now this is the key, this is color-coded. If you see a green candle after the doji, and this one happens to be a hammer pattern after the doji, then I would lay into this one and buy the rest of the position in, putting your stop below the lows in this grouping area, or below the low, in a percentage below the low here at the doji, or below the hammer. And then you basically trail your stop up. Trailing the stop is basically where you put a stop loss order in and as the stock moves up, the sell order also moves up in price. That's how you trade the doji. You would also apply that to a hammer pattern. Now, spinning top. What is a spinning top? Well, again, the Japanese were brilliant. They basically called it the way they saw it. A spinning top is a small-bodied candle. Here's one right here. A small-bodied candle with a shadow above and below. A lot of this, the spinning tops that we see are going to have shadows that are equidistant from the center of that body. But sometimes you'll have spinning tops that look a little bit less equal in here. Here you would have a spinning top. Let me just point out some of the spinning tops for you. Here is a spinning top. And again, here's a spinning top. And here might be considered a spinning top. Here's a spinning top. Here's a spinning top. Here's a spinning top. The spinning top is a sign of indecision. It's not a point where I will take a new position or even close an old one, but I would very strongly recommend that what you do on the spinning top is you make a move to protect your position. So if you're long the stock and all of a sudden you see a spinning top here or even here or here, I would then move my stop from a low area here up to the lows that are beneath the spinning top. So to give you an example, if I had bought anywhere in this area right here and I would have moved my stop up, I would have put my stop below this low. This is a day I would have been stopped out. Now I know I'm going at a fast pace, but this is how we teach, and this is how the market is going to teach you. The market does not wait around for you to figure it out. Preferably, you're making profits along the way. What I would suggest is you tune into our Q&A open house session, which is once a month. The first Monday after every options expiration Friday is when we have that. So stand by and ask your questions, and we will take it from there. So have a great trading day. Keep your stops in place.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.